kick this off. We got a little bit of a late start today because the House ran late. But I want to thank everybody for coming this afternoon. Thank the members. I know it's late in the afternoon and you have places to be. We may have some people joining us as the day goes along. We spoke a little bit at our last meeting about what we were going to do today, and we were very fortunate to have Mr. Leonard Gilroy. I think he goes by Lynn most of the time, or at least with his friends, so I just call him Mr. Gilroy. But he is going to talk to us a little bit today. The title of the presentation, Pension Solvency and Public Education, and it's a case for reforming our TRS system. I want to say this, and as I introduce him, let me recognize Benita Dodd with the Georgia Public Policy Foundation. We did this presentation, Mr. Gilroy and I, a few weeks ago at a meeting, I guess a month or so ago, just to bring up the subject. And I want to make this real clear as we start, because I know there's some educators in the room. I know there are people that represent educators. The reason, from my standpoint, to have this discussion is not to take anything away from our retired educators, not to take anything away from our retired teachers. In fact, it's just the opposite. Representative Fraser and I spoke at the last meeting and before. I think this is, to have this conversation is an absolute commitment to the educators and the retired educators. Anytime you talk about a pension system and reform of one, people immediately think in order to do something or save money or make it better that it means lower benefits. I think when we see the presentation today, you'll see that that is not the case. So no preconceived notions here other than we have a commitment with our current system to people that spend a lot of time and do a lot of good work. It's costing the state tax dollars a lot. We're behind in some cases, and that's costing us more. So with that, if we could hold our questions to the end, and we would take committee questions if Lynn has time, and we'd take questions from the audience. We'll try to do this in an hour. But if nobody has a burning question, I want to move on to the presentation at this time. I see no red lights up here. Mr. Gilroy, if you would come forward, and while you do, I'll come ahead to walk over there if you'd like the podium. Let me do a better introduction. Leonard Gilroy is a Senior Managing Director of the Pension Integrity Project at the Reason Foundation, a nonprofit think tank advancing free minds and free markets. The Pension Integrity Project assists policymakers and stakeholders in designing and analyzing and implementing public sector pension reforms. He's also a Director of Government Reform at the Reason Foundation, researching privatization, public-private partnerships, infrastructure, and urban policies. So we thank you for flying in to see us today, and with that, sir, you have the floor.
Thank you, Mr. Chairman, members of the committee. It's an honor to be here today, and I appreciate the opportunity to speak to you. Just a quick, to elaborate maybe a little bit on what Mr. Chairman said a moment ago. A couple months ago, in conversation with Kelly McCutcheon, our friends over at the Georgia Public Policy Foundation, we'd talked about doing a solvency analysis of the teacher retirement system, and presented that in a forum about a month ago or so, and Representative Martin was kind enough to join me there, and so he thought it would be a good idea to sort of share some of this with the members, and so I'm happy to be here and happy to present this, and happy to take any questions afterwards. And if we run over the committee time, I'm happy to stick around afterwards and beyond that to answer any questions that you may have. And just quick introduction of who we are, what we do. Reason Foundation is a national think tank, and our Pension Integrity Project is something we launched a few years ago because we saw in a number of states across the country that there were some major issues with growing unfunded liabilities and sort of financial risk embedded in their public sector pension systems. And so we've always sort of taken the approach that it's not sufficient just to write papers and talk about issues, but it's also helpful to roll up your sleeves and work with policymakers and sort of be an action tank in addition to a think tank. And so we offer ourselves as pro bono consultants effectively to legislators across the country. We don't take government money. We're not real consultants. We just offer basically technical assistance. And, I think one of our signature projects in this arena would be in the state of Arizona, where I live. 2 years ago, we worked hand in hand with police and fire unions in our state who were basically very prescient in looking at potential bankruptcy situations down the road for some of their employers based on the skyrocketing cost of the public safety pension system they were in. And we, on behalf of our Senate leadership in Arizona, worked with the public safety associations to design, negotiate, craft, and ultimately put into place a reform that effectively put their pension system on a path to solvency. And so that's the type of work that we do across the country. Anyway, that was an introduction. I wanted to just basically walk you through. I've got a long slide deck here. Any of you have a printout, you can see that there's a lot of slides here. I am not going to walk you through all of that. I know you've got other things to get off to today, and I present it there for your information if you want to look back later. So I'm just going to basically skim through and give you an overview of what we see as maybe some issues to take a look at in this system. And I will say, relative to some of the other systems that we work with and looked at across the country, Georgia TRS is definitely not in the same boat as other states that make the headlines routinely in this arena, and that's a good thing. But there are still some areas out there in which we think policymakers should be watching and taking a look at in collaboration with the stakeholders of the system. So I will, with no further ado, I'll jump right into it. And I'm going to skip through this. I'm going to go fast, save any questions if you don't mind. Actually, I don't mind. If you want to throw in a quick question along the way, that's fine. If it's something a little longer, maybe we can hold it until the end. But just to give you a snapshot of the system today, you have a system that is basically went from, in this century, has gone from being overfunded, meaning over 100% funded, down to just shy of 80% as of the last valuation report. And over that same time, went from being overfunded by about $2 billion back in around 2001 to over $18 billion underfunded today. And what you can see there is, just one thing, this actually is not as, the red, we call this sort of the mountain of debt. That's the sort of red bit. And that's showing, if you kind of match that up with the legend on the left-hand side, that's showing you the 18 billion. One interesting thing here is that a lot of people just sort of have this notion that, the health and solvency of pension funds rises and falls with the stock market. And one thing that you can sort of see here is if you look at where like 2008 happened, and then in the wake of that, we've had a historic run-up in the stock market since then. But what you can see here is that historic run-up, despite the amount of equities that are sort of invested by the plan, which we'll come to later, are not necessarily tracking that outcome, meaning you've seen the markets take off. And what you see here is at the same time that the markets have taken off, the debt has basically sort of hovered and spiked a little bit. And some of that's due to assumption changes, and there's factors around this, but what you haven't seen is sort of the precipitous decline, which one might intuitively expect if you thought that pension solvency and the health of the markets are, sort of in lockstep. They don't move that way for a lot of complicated reasons. There are lots of different ways to calculate the growth of pension contributions in this state. I know that it became, a lot of people took notice when there was about a $350 or so million additional contribution this year to the system, and that's the kind of thing that gets headlines. But if you look back over time, you can see that you've had the growth of the contributions toward the TRS pension system that for many years were sort of underpacing the economic growth of the state, but hit a crossover point in about 2014, 2015, where now those contributions are outpacing growth. We'll see where that goes. Those lines could converge again. I don't have a crystal ball, but this is what's been happening. Same thing if you look at how the unfunded liability payments, just the portion of your pension contributions going to pay down the debt, not to cover current benefits, but just to go down, pay down the debt that exists today. As a share of total payroll, you can see where that's going, and that's rising. Same thing when you look at it from just as those amortization payments or pension debt payments, if you will, as a percentage of the general fund. You can see the trend line there. This slide on this number 5 slide, it looks a little tricky, but what it shows is the numbers that are kind of in the middle of these columns, every couple columns, that's the total dollar figure of the employer side contributions here.
Let me just, if I can, because I've heard this a couple of times. let me back you up. You don't have to back up a slide, but just talk about what you just said, the portion of our payment that's going toward what the teachers and the retirees are going to either are getting now and are going to need, and the portion of that payment that's just going to fill in that we're behind. I mean, and that's what you're talking about in the next slide, but
I'll
just
skip to it.
Till everybody knows that there are really two factors here. Our payments would be less if we were fully funded in the past, and they're not now.
Right. Thank you, Mr. Chairman. That's a good point. And so, an important thing to understand about how public sector pensions are funded and what the contributions go to is that essentially if you have a system that is fully funded, then the only contributions are basically going to pay what's called the normal cost. And that's basically the cost of pre-funding the employee's benefits for that coming year. Okay, so that's basically the cost of pre-funding. And in a system that if it was basically going to stay on the rails at 100% funded the entire time, you'd only be paying the normal cost. And what that would basically do is that's the amount that you would invest, and if you hit your assumed rate of return consistently, what you put in up front plus what you make on investment returns would be at the end of the, sort of an individual's career, they'd have enough there sort of set aside for them to cover the entire value of their benefit. However, in systems like most, that we run into, I mean, there's very few, some, but there are a few that are fully funded today. You then have a second payment on top of that, or a second portion of the contributions, which is just basically, it's amortizing debt, just like you would pay a mortgage. You stretch that out over 10, 15, 20, 30 years. And so there are then two components then. You have the cost of pre-funding the benefit, and then you have another cost, which is just paying down the debt that has accrued, okay? And in this chart here, what you can see is this is just showing two different years. The 2017 valuation report, or that's fiscal year 2014, but they project those rates out 2 years. That's sort of why the numbers look like that. But if you kind of look down here where it says in big bold letters, employer contribution, you can see the breakdown there. And what that's showing you is that as of the latest valuation report, this would be the 2018-19 contribution year, you're putting in just shy of 21% of payroll as a contribution to the system. And of that, about a third of it is going towards covering, pre-funding current benefits. The remainder, which is about 2/3 of it, is going to pay down debt. So basically what then this is showing in the previous slide is that green bit, that's showing that over time, debt payments are basically becoming a bigger proportion of the total contributions. And so that's what this is showing. And then the numbers that are in sort of the middle there are the total contributions and what that adds up to. And sort of the green and blue are basically how that breaks down proportionally. And then and the other thing I guess to note back on this slide 6, just an important point to note, is that if you look at the unfunded liability portion, that 13.13%, again in the 2018-19 year, that is entirely paid by the employer. Okay, so the employees you can see at the bottom, they're contributing a statutory 6% of payroll, but the normal cost is set over 7%. So therefore, you can just tell right there that the employees are basically contributing the bulk of the normal cost, and then the employers are kicking in the remainder plus all the unfunded liabilities. That's a way to sort of think about this.
You have a quick question.
Mr. Chairman? Yes, ma'am.
I appreciate, but I need you to slow down
Okay.
just a little bit so
Yeah.
I don't have to ask you a whole lot of questions.
Okay.
I know you have a lot of information you're trying to cram in this little period of time, but I think Mr. Chairman will leave it ample time to meet. My question is this. I partake in the TRS system right now.
Okay.
My husband and I. So I need to understand that debt part of it as it relates to the amortization. If we got stretched out 10 years or however, and but this debt period where we have to pay down the debt. I need you to just elaborate a little bit on these debts, the debt part of it. What am I paying?
Sure. No, it's so I actually have something broken out here that I'd like to, I'll point it out when we get to it. But essentially, any year you have pension debt, you amortize that over some period of time. It might be stuck here. I don't know if someone can, there's a tech person that can come here, but it looks like we might be stuck. But so just to explain, pension debt is essentially, you have to pay it off somehow. In an ideal world, you would just pay it off as it accrues, right? So let's just say in this year, so let's say you're fully funded, and then next year you have an unfunded, I'll put numbers on. Let's say you have $1 million of unfunded liability. It would be great to have a situation in which you could just pay that immediately, pay off that 1 million, and then you're back to full funding. Usually the,
If I could just stay close to the
oh,
microphone.
okay.
It's,
There may be people listening.
it's videoed for archives. So this, and it should be fine, just up down.
Okay, good, thank you. If you had a fully funded system and an unfunded liability of $1 million in a year, if you could pay that off, that would be ideal. Then you'd have no more debt and you would be back to 100% funded. Usually the numbers that we're talking about are, you know, sort of budgetarily prohibitive, and there's just sort of a general practice in the pension world that you typically will spread that debt over a certain period of time to be able to pay it down in a way that works for your budget, right, to work from a fiscal perspective. So you have a lot of different ways you can do that. I mean, you know, one thing that Georgia did that I think was very, very prudent, and this is a credit to the board of this plan of TRS, is they went from what's called an open amortization to a closed amortization a few years ago. What that means is at one point in the not too distant past, they were essentially re-amortizing that debt over, I think it was 30 years. I could be wrong on that number, and I'll point it out later. But basically refinancing it every single year. So and that's called open amortization. And that means you basically never are going to pay off the debt. You're basically accepting that you're going to have just a big chunk of payment that is, you know, not going towards a current benefit or a current operating, you know, expenditure. What's the more prudent approach, and what your board prudently did, was closed that and said, nope, we're going to put a date certain on the end of this, like a fixed rate mortgage. Just like if you go out and buy a house. You some amount and you spread that out over 30 years and it's an equal amount, you know, that sort of thing. Now there are different ways to do that. You can do equal amount payments, you can tie it to payroll, there are lots of methods, and there are certainly best practices around that, you know, I'd be happy to talk about. But essentially, one way or another, when there's debt, you have to pay it down, and the typical practice is spread it out over a period of time. Shorter's better. Closed is way better than leaving it open and just refinancing every year. But I don't know if that's answering your question, but as these mount, the new debts just sort of get layered in, and that's why you see sort of rapid increase. And that's why you see that green bar basically getting bigger and bigger over time, because the debt, you're not paying it off, you're not paying down the debt fast enough to keep up with it, is essentially, we're going to come to that in a minute. So did that answer your question?
Chairman, just one question. And does that have to do with the economy actually on getting the debt down year after year after year? And is it also has to do with the number of employees?
You're asking a great question, and we're going right there right now. So
Okay,
maybe I'll
thank
just
you.
jump right in.
All right,
So what we
I'm
see,
done.
thank you for the great questions. So what we see is sort of the challenges facing this system right now. It's important to understand what that debt is, and your question, Representative, it was spot on. Why? Is this the economy? What is this? Well, helpfully, the evaluation reports for the plan break that out, and we sort of grab that over a period of time and aggregate it. And so basically, if you tally up that 18 point, what have you, billion, this is how it breaks out. What you can see is about half of it is due to underperforming investments, and that's, to your point, the economy, the recession, big factors, right? And then there's also something that you guys do here in this plan called interest rate smoothing. It's very complicated. I wrote it out on a slide, but it's essentially a way of, it's an alternative way of sort of discounting the value of your liabilities over time. And if you sort of take those two together, it basically adds up to about half. And again, this is kind of going back to my earlier point. A lot of people would think that, well, if you had a recession and the markets took a big hit and we're sending this recovery, well, that's probably the biggest factor. And what you can see here is that it's a factor, and it's a big factor. It's the biggest, but the biggest factor is still only about half of it. There's other things happening. There's assumptions. And we're going to go through this in a second. But it's not just the underperforming investments. There's also the actuarial experience. There's the assumptions that are made across a variety of when you're trying to project out a plan for decades in the future, you have to make a lot of assumptions about, mortality, what the economy is going to look like, what salary is going to grow like, what payroll is going to grow like. I mean, you can start inflation, you can start going down the line, and there's a lot of, it's not just what do we think we're going to get in the markets. It's lots of other factors because you have to value this thing over a long period of time. And at any time some of those assumptions are wrong, it will create a deviation and create that sort of debt situation. Now, it could also go the other way, right? If you underassume and you come in over what you're assuming, maybe you actually can have, and actually we see this here. We see that perversely. I'm going back to the previous slide. You see this little green bar that's underneath, that's kind of going below the line. This is sort of a perverse, quote unquote, benefit to the system, but not so beneficial to the employee side. The pension system would have been about $2 to $3 billion more in debt if salaries had actually grown at the level that the plan had expected them to, but salaries didn't grow that fast, and so it's actually a net, it sounds perverse, it's a net benefit to the pension plan, but not so much on the employee side, right? And so, anyway, you have a lot of crosswinds and factors that sort of interplay there, and so, there's no one factor that drives all of this. So another problem has been negative amortization, and that's basically a fancy way of saying you're not paying off the interest on your debt fast enough. You're not paying down the debt at all. You're not even keeping up with the interest on the debt, and that is that's a challenge. Part of that has to do with stretching out debt payments over a longer period of time. It's a lot better if you can keep it tighter because you have less risk of that debt just sort of ballooning due to other factors. And then also we would say that looking at just sort of the discount rates in the plan right now, we think that the methods are under-calculating what's actually being promised. And so if you're under-calculating what the total pension promise is, then you're not putting in enough now on a year-to-year basis to fully fund it. And so we think that's a problem too. And these are, I just want to be very clear. This is not picking on TRS. In fact, TRS is probably, these are challenges, but we see them very much worse, in a lot of other plans. So I'm just for perspective, I want to make sure that that's very clear. And that, I'm going to just jump in to go put a couple of points on these, and then we'll kind of get to the end, because I want to be able to take your questions and move the conversation forward. We talked about the assumed rate of return, just to break that out a little bit. Well, this is stuck again, not quite sure, but yeah, it's not doing it. I'm not sure. I will. Apologies, technical. If you want, if you have printouts, I could just go through off the printout.
It is completely closed.
Yeah, they're small.
They're small. Oh, all right, here we go. Here, I'll find it. Thank you. Okay. Well, I will, while we're waiting for this, I'm just going to continue to go through the paper version, and then we'll pick it up when this is ready to cooperate. I think, so one of the things I wanted to point out is that if you look at the assumed return, you'll see a couple of different ways of sort of thinking about this and calculating it. Sorry, 1 second so I can open this up. Okay. It's very good. All right. So sorry about that. So to put a sort of point on this, before talking about the actual returns for this plan, I think it's important to just have a little historical context. One of the main reasons that pension funds across the country have had solvency issues is that 30 years ago, back in the 80s, 90s, it was fairly easy to hit a 7, 8, 9% assumed rate of return for a plan. You had interest rates that were up around those levels. You can invest in a very safe portfolio of bonds and hit that return. If you remember if any of you bought property back in the 90s, you'll remember that interest rates were not down in the 3 to 4% zone. They were up, much higher than that. I remember double digit on the first place that I ever was purchased back then. And when your market and your interest rate environment is at that level, it's fairly easy to hit an assumption like that. But what we have seen is that for a variety of reasons, since 2000, since the recession, what many folks out there have entered what you would call a new normal. And what that is characterized by is very low interest rates. If you sort of track, we have this later in a slide I'll show you, but if you track where the sort of treasury rates have gone over that period, you'll see a plummeting. They've been plummeting over that period of time, yet if I mapped pretty much any public sector pension plan assumed return assumption next to that, those have stayed flat. And so what's happened is that the assumptions have stayed flat while the market bottom has fallen out, on the interest rate side. And what that has meant is that a lot of plans, and TRS is a bit of an exception, have gone out and really had to chase much higher returns by going and investing in much riskier assets to try to maintain that high level of return and not just be able to go out and get it in the bond market. They've had to go and chase private equity, hedge funds, real estate investments, all these alternative investments, trying to chase that return. And that has, and missing it, that has created a lot of unfunded liabilities across the country. And what this chart is just showing, this is something that McKinsey & Company, this is a global consulting firm who looks at these sorts of issues. They've done, and we've seen a number of other forecasts that look very similar. This is pretty representative that says, what we've gotten in the markets over the last 100 years, over the last 30 years, are not indicative of what we expect moving forward. In fact, moving forward, we expect something lower. And if you look sort of here, it kind of goes by category of different types of major investment options. And what you can see is that the past and the future look very different. And even if you look at the rosiest assumption for the next 20 years, you're seeing numbers that just don't add up to 7.5%, 8% in terms of a blended portfolio. So that's a challenge. Okay, here we go. Another way to sort of think about it is, well, let's look at sort of just the TRS investment returns over different periods of time. There's no one magic snapshot of a time window that's going to tell you the magic piece of information you need. You have to kind of look at it over different time periods to figure out what's going on. I mean, oftentimes we'll hear plans say, we've had a couple of bad years. We've had a decade of really bad years, frankly, but over the long run, if you look at the last 30, we've been there, we've hit our returns, so we think we're gonna stay there, we're gonna revert back to the mean. And that is that's one perspective, and there's a reality in which that could happen. I think if you look out there, though, we would sort of suggest that going back to 30 years is going back to a period of time that doesn't exist. I mean, we don't live in the 80s and 90s anymore with market or interest rates that high. It's just a fundamentally different economy. The workforce is different. Everything is different. The global economy is different, and that's where we live. And so we would suggest that prudence and caution would be warranted based on sort of the signals out there. And if you just look at TRS itself, different timescales, you'll see different types of returns. In this sort of left-hand side little bottom box, you can see how the numbers vary over just depending on how you slice it. For most of the periods in the last 20 years, again, depending on how you slice it, you can see that the return has not hit 7.5 on average over those periods. It's only in the last 5 years where you do hit that, and that's capturing, at least 1 year of a good, a really solid year, probably 2 or 3, because you had a couple over the last 5 years that have been just nationally good years for the market. Again, and sort of that, run-up of the market is some of that's being, a little bit captured here. So we think when we look at this that there is it would be prudent to suggest that 7.5% may be unrealistic, and in fact we're starting to see 7.5% now being a little bit now. It was maybe 1 or 2 or 3 years ago maybe about the average. Now the average is starting to pull below that across all public pension plans, and we're starting to see them going to 7. Now some are going south of 7 because of the same reasons. And CalPERS, let me just say this, CalPERS, California Public Employees Retirement System, that's the biggest one in the country. their investment advisors told them, and this is the biggest one in the country, the market leader, if you will, that most watch, you pretty much can bank on about 6.2% over the next 10 years. So that's the kind of environment that we see out there moving forward. And again, this is just sort of one way to look at, sort of the pension solvency versus the stock market. You can see, again, the blue line is the pension funded ratio. At the same time, all the green is the run-up in the markets since then. And what you've seen is if they were working in lockstep, they'd be both going in the same direction. And then the last point on this I would just make is that the plan has consultants and they have a set of assumptions and data around that. And they basically believe they have about a 60% chance or so of hitting the 7.5% assumed return. We've done some other analysis out there looking at different types of market forecasts, and this is just 3, BNY Mellon, JP Morgan, research affiliates, just 3 different groups out there that do forecasting. And when we sort of match the TRS portfolio to those expectations, we think the probability of hitting that 7.5% return is much lower, and we think it's probably going to be safer somewhere closer to the 6%. That's sort of the shaded boxes. Now, again, there is no crystal ball, but in the absence of a crystal ball, you have to make some determinations. And when we look at this and aggregate this, we think that 7.5 is probably a bit too high. Okay, so we're stuck again. Oh, no, okay.
Well, let me let it catch up if I can
Please.
ask you a quick question.
Yes.
And to that, when you say 7.5 is a bit too high, when I just want to be clear, when we're talking about the returns may not be there, your suggestion is not to do anything on the benefits end of the system. But I just want to make that clear with everybody, because typically if you don't get the return you want, you don't get what you, if you're not getting the return you want, you don't get what you need at the back end. We have a defined benefit system, so we have to provide those benefits. Thus the conversation we're having today to realize if those assumptions are incorrect, that we know them now, because it's just like saving in your 20s is better than saving in your 30s, and all of that's better than start saving in your 50s. So just to be clear, when he says we may not hit the, because of changes in the overall world economy and investment returns, that we may not be getting the 7.5, it's not a suggestion that a reform means anything to do with the benefits. We need to realize that and affect contributions or some combination of other assumptions.
Yes, Mr. Chairman, that's a great point. And yeah, I mean, when you're looking at if that's the problem, if 7.5 is too high or the assumption is too aggressive, then it's sort of a couple of choices. It's lower the assumption, but when you lower the assumption, this is what I'm showing you now. This is it's tiny number 24. I'm not sure what page it's on in your handout version, but what this is showing is sort of the current normal cost versus if you lowered that assumed return, what that would look like. And what you can see is that the normal cost will be higher. Of course, because you're basically assuming you're going to get less in the marketplace, so then you need to put more in now. So what that means is we think it's very prudent to have realistic assumptions, but we also recognize that you got to get there somehow budget-wise. And you've already had, I know, a couple of years of some major jumps in the level of contribution, and so that's a fiscal challenge, and I get it. And when other plans and other states sort of confront that issue, believe me, everybody has to confront this sort of thing. We see a lot of interest in, we know where we need to get, but we know we can't get there today because we have other things to fund in the budget. So let's set ourselves on a path to get there over some reasonable period of time. In California's case, for instance, they've decided that their investment advisor was saying go down to 6.2%. The board said, okay, we're going to go partway and we're going to go to 7%, and we're going to do that over a period of time. And that's one way that plans have gone about doing this, and we've seen this in other states. So the other thing, I guess, to understand is that if you are knowingly keeping an assumed return high and not getting it, what you're basically doing is structurally underfunding the plan, and you're basically throwing that into the debt side of the ledger. And what that means is it's a tricky position. You either pay more now or pay even more later, because the interest on the pension debt accrues at the assumed return of the plan. So that debt's going to rise pretty quickly. The faster you can pay it down or not have it in the first place, it's better.
I have another question, number 24. I don't know which one that is. Is it Representative Gilligan?
Thank you. And if you don't mind, just walk me through this chart that you have here, because assumed 7.5% normal cost.
Oh, yes.
I'm trying to make sense of this, but to me, this is hieroglyphics. So if you would put it in English, lay terms that I can grasp, I would greatly appreciate it.
Thank you, Representative. I will do my best.
Thank you.
So earlier I mentioned that there's something called normal cost, and that's just the cost of pre-funding the benefit. If you're 100% funded, that's all you'd be paying. Okay, so that's just saying we're going to put in this amount of money, and we think if that money invested, if it gets what we think is the 7.5% assumed return, at the end of the day, the money will be there to pay out the full benefit. Okay? And
Lynn,
then, yes.
can I just, just because Lynn and I have been before, that is a number where if you were doing it individually and you said you wanted to have this much money when you got 365 and you did a present value of that at 7.5%, that would tell you how much you have to put in each month to get you there. We just do it over tens of thousands of employees that retire at different times. That's what that normal cost would be. It would be how much my wife and I have to put in if we want to have X dollars at 65. That's what you had communicated to me when I needed it in non-hieroglyphic terms. But they do it on a 10,000, people retiring at different times, starting and all those things. But that's what the normal cost is. And just like with our 401k, if I assume less return, I have to put more per month to get to the same amount at 65.
That's correct, Mr. Chairman. And so what this is showing is just that the column that says gross normal cost, that's just the full dollar figure. And then that's broken out between the employees put in some of that, the employer puts in some of that. And so the next to that is the two numbers that add up to that number. So the 7.8 on the top row, 7.84 plus 6 equals that 13.84. And so it works that way. So all this is showing you is that here's what happens on the employer side, because the employees are fixed, right? They're statutory set at 6%. So that means that if you change that assumption, that figure rises. So if you just go down the normal cost column, you can see that starting to rise. And if you go down the employer side, you'll see what that means in terms of employer contributions. And so that's what this is just showing is if you change that one lever, if you pull the one lever and move it a little bit, this is what happens.
And that is then because, Mr. Chairman, if you don't mind a follow-up question? Okay, that is because we are assuming that there will be X amount at the end of when I'm ready to retire, that there will be X amount. It's not based on then, in my 401k, if I only got a certain amount rate of return, that's okay, that's your rate of return, have a nice day. But this is because we have guaranteed a certain figure for these people, and therefore if it's lower in our rate of return, it's higher that we as a taxpayer put into it to guarantee that retirement sum.
I think that's a fair way to characterize it.
Okay.
Yeah. And so the pension benefit itself is basically, it's just a formula. There's a multiplier, there's the number of your final average salary, and sort of a service credit, term of service credit, number of years basically. And you multiply all that out and you get a number, right? And you can calculate what that's going to be over someone's lifetime very precisely, when they're getting the benefit. But today, when they're starting employment, it's very hard to do that with accuracy. And so this is all about trying to steer it in a direction that it's manageable. And avoid shocks. But the problem is we've had some shocks in the economy that have made this stuff a little trickier. So did that answer your question? Okay. Thank you for the question. All right, so I know you have things to do this evening, so I'm going to burn through this much faster.
Well, let me say this. You came in here, I think there were people interested. I said we'd try to do it in an hour, but out of interest of people's time. If we're not getting there, if you could have some time for questions, we can go longer. We're here tomorrow. I think this is an important matter is what I'm getting. So I think Representative Fraser wants you to take your time. She doesn't want us to hurry through this. Is that right, Representative?
Yes, and Mr. Chairman, if I may, everything that you're speaking of as it relates to the employee contribution, employer-employee contribution is correct. Even when I was in the system, we got our annual report. And it based us all the way down, just like a Social Security report, all the way till you get to the age of 62 or something. This is how much you pay in, this is how much you're gonna get out. So we kinda actually knew exactly how much money based upon that percentage that they had. And they had 2 or 3 columns like that, saying if you pay this, you get this amount at this age, all of that, all the way down. So we knew that, but in the system, we're thinking only that our retirement, based upon conversations we have with TRS in the system, we're thinking that this is only based upon our investments. And I have just learned from you today that it's more than just those investments that we make to try to accumulate more funding. It's more than just that. Now that I see that, I know that, and I'll be able to also share that in an upcoming meeting I'm having with some teachers, so that, because they're thinking, well, the system is not investing good in the economy, and the economy is going bad, so, my retirement might be reduced, or in 20 years, I might not even have it, based upon the economy. That's the scare that you have out here. But it's just, that's because we're not getting all the information, misinformation, because we're thinking it's only based upon investments.
Let me help, and I'm gonna let you get to the investment part, but I mean, as I understand the TRS system it is to our teachers, many bad things would have to happen in the state before the contractual obligation for a retirement, a pension plan would be broken. You can't sit here and never say never. I mean, I mean, we just don't know what could happen out there in the world. There was a depression that nobody looked at when the stock market crashed in the early 1900s. But something of that order of magnitude would have to happen for our pension plans. I mean, I believe you've probably seen those around the country. I mean, courts are pretty serious with those guaranteed benefit programs. A state has to be in a world of hurt financial position before they're able to unencumber themselves of those. And Georgia's AAA bond rated, so we're not headed there. So I don't want anybody to look at this and say when we're reforming this insolvency that we're anywhere close to that. Or even the fact, and this is my opinion, I'm not a financial analyst, but that the board is necessary, or the investment officers are necessarily doing a bad job in not attaining the 7.5%. It's just a hard thing to do in a pension with a balance, a capital amount of money our size. So just anybody that would be watching that or sitting here or reporting on this, our teachers are going to get their benefits. What I want, back to what I really want us to do, is to see what you've seen, that there is that debt portion, that part of the money we're doing is filling that in. It is important to do that. Just because the check's getting there for teachers today doesn't mean there's not debt to make sure that we have to make up to get it to the teachers in the future. So I'm sure I didn't articulate that completely correctly, but teachers should feel good about getting their benefits, but we do have a hole that needs to be filled in for us to be even more actuarially sound in the program than we are today.
And Mr. Chairman, you really don't have to reply on what I just said. You've already covered that. I just want to know, where do we go from here as it relates to our projections for the future?
Well, yeah, let's let him go there. I have some thoughts in conjunction with some other folks in the leadership in the legislature. We might have an opportunity to work on some things with some good people.
Mr. Chairman, and to the points that were just raised, I just want to be very clear about it. Yeah, I mean, pension benefits are generally viewed legally as a contractual right, and are basically protected under the contracts clause of the federal and state constitutions. Some states, not Georgia, but others even have a sort of super protection. Illinois, Arizona, California sort of got this through jurisprudence, but even another layer on top of that in the state constitution to protect the benefit from being diminished. So that's the reality of it. The only times that you really see pension benefits being diminished are like a Puerto Rico situation, which is, I think most of us would look at that and say, that is an economic, basically disaster. Like a Detroit situation, in a bankruptcy, in a municipal bankruptcy, states can't go bankrupt, obviously, but municipalities can. And so, in those cases, you've had Central Falls, Rhode Island, Pritchard, Alabama, Detroit, have seen pensioners get haircuts amid bankruptcy restructurings, but that's not applicable in this case. Essentially, because of the strength of the guarantee, there are slight modifications you can do to pension benefits under the federal contracts clause. I'm not an attorney, but this is what I understand. They're very limited, and basically the bottom line is once pension benefits are granted, they're guaranteed. And so from the state's perspective as policymakers, I would suggest that should be your perspective, that once a benefit is promised, it's guaranteed pretty much no matter what. And that is where the debt problem comes in, because if debt keeps rising, then that means more and more money from the state budget and school aid budget going into pensions, not going towards other state priorities, not going towards, you could name your priority, not going towards teacher pay increases, not going to the classroom, not going to X, Y, or Z. Whatever your priority is, it's being, that crowd out from the debt, that's what's at risk, is basically letting, the costs of the past are, at some point pushing into the cost of the present. And that's the real challenge. It's not about benefits being at risk. It's more about having other services and other, the rest of your public services at risk. That's typically under the pension crowd out banner. And if you sort of Google around that term, you can see very real examples of it out there. I hope that answered your question. One last point on the sort of assumptions and that sort of thing. You can read more about this in here. I will leave some of this for your own reading. But just to put a point on it, if you look at what we call negative amortization, or that means you're not even covering the interest on the debt, much less taking a crack at paying down that debt. If you look at over the last decade or so, you've had about $3 billion in negative amortization. That's a problem. We also think that just the way you're valuing the liabilities is perhaps riskier. And this is a philosophical debate. Actuaries, if an actuary was standing here, if the plan's actuary was standing here right now, they would argue this with me. There's just two different perspectives. We believe that because of the certainty of the benefit, that you should treat how you value those liabilities. When I say liabilities, what I mean is pension benefits promised. How you value those, because they're certain, you should value them with certainty. And that means at a pretty low rate, I don't want to say risk-free rate of return, but something in that closer to a risk-free rate of return. There's debate about what that would be. On the other side, the plans would say, no, we think if we're going to invest the money and if we think we're going to hit it at the 7.5% level, we're okay with valuing our liabilities that way. And that's just a philosophical thing. But we look at it and say, this is an ironclad guarantee for all intents and purposes. And so valuing that with a level of risk in it, it just doesn't make a lot of intellectual sense to us, but it's a professional debate, and I will fully grant that. So this is our perspective. The plan would tell you something very different. But what we think is that, just to put a point on it, we think you don't need to value your what you think you're going to get on your invested assets at the same rate as your liabilities. The plans do treat them typically as the same number. But if you just for a thought experiment, we showed, again, this is similar to what I showed you earlier, what happens to your cost if you don't, if you change the assumption. Here's what happens to the value of the pension promises and your unfunded liabilities if reality is different than what we think it is at 7.5%. If you step that down 100 basis points or 1 percentage point, what you can see is that an unfunded liability of about a little north of $18 billion suddenly turns into a $30 billion unfunded liability. And that's because the total liabilities grew. And if you start ratcheting that down further, you can see that your unfunded liability, depending on what you think the future looks like, is anywhere really between $18 to $58 billion. That's a lot of risk. When we sort of look at that, and so that's the point I'm trying to convey. I'm not trying to say it should be valued at a 4.5% discount rate. What I'm saying is that there's a lot of room around this for interpretation and decision making, and the typical practice is to be on the rosier end, and we think policymakers should be cognizant of that as they're making decisions. This is sort of this chart here. This is number 38. This is a way of illustrating what I've said to you earlier. This yellow line at the top is the actual discount rate for this plan. And what you can see is it's been at basically 7.5% for about 20 years now. A little dip at the beginning. They dropped it down and went back up. But that's the yellow line. The blue line, that's what's happened to the Treasury rate. So that's showing you what the risk-free rate of return looks like out there in the marketplace. And just since 2000, you've seen that fall by more than half. Okay? So what we would like to see is the plan's assumption move with that. Had it done that, it would be the green line. That's what you'd be looking at right now. And if you just literally tracked the movement point by point with treasuries, you would not be at 7.5 right now, you'd be at 4.4. Again, I'm not saying that's the right number. What I'm saying is, just as a thought experiment, this is the kind of dynamic that's sort of behind the scenes right now. And then another point would just be to say this is when you sort of look at the plan data, the actuaries have to assume, they don't assume that everybody that gets hired, if you have a pool of 100 people that get hired on January 1st, they don't assume that all of them are going to make it to December 31st or to December 31st of the next year or year after that. And so they have to basically look at what's the turnover look like, what's the attrition rate amongst this population, meaning the teachers and the folks in this plan. And what you tend to see is that you have, in this profession, and actually many others in public service, you see this a steep drop-off in the first years, and that first hard line is the vesting point. That's the 10-year initial vesting point. And what you see there is that the plan is assuming that, again, these are the plan's numbers, these are our numbers, you can see that in the source data, but the assumption is that 73% of, say, a pool of 100 people walking into this profession on day one will not be in this system 10 years from now. 73% won't be here. Now, they may have left, they may have gone to another state, don't know. But this is the trajectory of the folks in the plan. This is the demographics in this plan. And then you have a slow between the 10 and 30-year period. 30 years is when you get eligible for your full, unreduced, full actuarial benefit at 30 years. And so you see this period where effectively 15% of that population of 100 make it to that point. And so our point in bringing this up is just to say that the defined benefit pension benefit that is currently offered is definitely working for those folks, at 30 and above. And it's working pretty well for the 10 to 30. If you leave in that period, you get a benefit. It's just reduced from what it would be if you stuck it out to 30. In some period of that, you would just get back your contributions in some portion of the employer, and then at some point, you get an actuarially reduced benefit. That's all very technical, but what's clearly, this particular benefit structure is not necessarily working for the people in the first 10 years. And so, a number of other states have looked at this dynamic and said, well, let's think about offering choices. Not swap out one benefit structure for another, but let's put in a portable benefit for folks that think they may only be here for a short term, and the more traditional pension benefit for those who think they'll be here for the long term, and let people choose. And that's sort of what came out of the Michigan teacher pension reform last year. Pennsylvania just passed something like this last year, where they're offering now all new teachers 2 different types of hybrid plan or a defined contribution plan, and they can kind of pick from a menu. That's sort of where things are going in this space, because I think there's a growing recognition that in the interest of retirement security, depending on where you fall on the years curve, on this curve here, your benefit is going to look maybe radically different, depending on where you fall. And so in the interest of retirement security, having benefit structures that are aimed at maximizing retirement security no matter where you fall is something of interest out there. And then finally, now I'm at the end, and so I'm not here to say, here's your answer. I'm not here to say, this is the reform solution that we think Georgia needs. I'm here to just say, we think that just based on the trends that I've just walked you through and that you can read more about, we think that there are some challenges that do need to be addressed. And in our perspective, reform means change. It doesn't mean wholesale, gutting of one thing and putting in something else. It means change, and it could be change on lots of different dimensions. and let me just stop here for a minute. When people talk about the words pension reform, for a variety of reasons, there's a segment of the population and policymakers that just go, oh, pension reform, they just mean taking away pensions from people. That's not what there are some maybe that mean that, but that's not what it should mean. You can reform pensions just on funding policy. We've done that. We've been working in South Carolina just to work on how do we get more money into this plan to make it solvent. You still have other issues to tweak, but that is a fundamental thing that can be isolated and treated on its own. You have assumptions. You can look at assumptions. You can look at plan design. I'm going to sort of walk through this. There's no one size fits all. All of this stuff is sort of, you have to look at what are the problems, and that's what we think the challenges, I've just walked through are. And then from that, discern, okay, now we know what the challenges really are. Let's break that out, and then you can sort of tailor solutions to sort of address that. And and we have objectives, and we think this is a set of objectives that, I think pretty much anyone can sort of understand and get behind. But the way that we approach what is good pension reform is, first and foremost, it has to meet the promises that have been promised. You have folks that have been, they took a job and a retirement benefit in good faith, and the government, in good faith gave them that benefit and should pay it. And so we believe that reform should have as a first operating principle, making sure that you're paying for those benefits that have been earned and accrued. And then looking at, of course, this is not just more pay. This is about a retirement benefit. So it's not just about let's get more money in a side plan that you guys can have, at some point in the future. It's let's design a vehicle that is primary intention is to deliver retirement security. And so let's think about that. Then you have this bundle of things that kind of are more in the fiscal realm, and that's the predictability, risk reduction, and affordability. These things are all this is where you're trying to basically balance these out. And what I mean by that is these are push and pull sort of issues. For instance, the easiest way to make an affordable plan is you could raise your assumed return right now to 15%. Your contribution rates are going to plummet. And, you will absolutely be underfunding the plan, but from a fiscal perspective, it would be affordable. But that's not going to give you a sustainable benefit. It's not going to give you that risk reduction in the long term because you've basically just thrown more risk into the dynamic. And so it's about how do you balance those things out? Predictability, making sure that, what a lot of plans are experiencing is just an upward trajectory in contribution rates, and it's not stopping. And stopping that, stemming it, or maybe even bending it, in the long run is something that, is definitely a goal fiscally in many jurisdictions, but you have to balance that with risk and affordability. And so those are tricky things to balance, but they should be there in the mix. And then finally, two more points. This has to be an attractive benefit. You can't just offer a meager benefit and then expect someone to want to come work there. We live in an economy, we live in a competitive marketplace. There are private sector employers, there's other governments out there, and you have to compete. And so, it's not just about what can we afford and let's just pay that benefit. It's about what do we want in our workforce, and then let's build the benefit to match that and to match our, our recruitment, retention, and all those sorts of goals. And then finally, good governance. And this is sort of the neglected piece often, but it's just making sure that, the organization of the board, how decision-making happens, how reporting and sort of internal decision-making and dynamics are effectuated. And so good governance is something, and we, I haven't seen anything that would suggest that there are fundamental issues on the governance side, but as a principle, we think that's important to just be cognizant of. And so here, just specifically, and this is what I'm going to wrap on, when we look at sort of, let's break this into a couple of bundles, we would sort of say there's 3 bundles here. Number 1, looking at your assumptions, looking at, these are things to tackle. We're not offering a solution. We're saying these are the kind of the things to sort of think about and tackle. Investment risk, looking at how to, essentially, how do you set your assumptions at a level that is going to give you a maximum probability of hitting them. And being right, if you will. So that's one. And, the plans already do, some amount of this through everyone's a little different, but usually on about a 5-year cycle, they'll do what they call an experience study, where they'll have the actuaries for the plan basically say, all right, let's look back over a chunk of years and how did we do? Did we hit the mark? Were we off? Were we over? And then, they will make recommendations from there that the boards can choose to adopt or not. Beyond that, it's, people, again, I mentioned this earlier, but people tend to get fixated on the investment side, but don't look at lots of the other assumptions that are kind of, I don't want to say buried, but they're in the background. And this is going to be how frequently people enter and exit, what new headcount looks like, payroll, salary, mortality, those sorts of things. Okay, so that's one bucket. Another bucket is looking at the contribution side and the methods for that. And we would say that, I meant this is a little more technical for this conversation, but happy to engage it later. There's a method there that we think should be just evaluated in terms of how pension liabilities are being valued through this smooth interest rate method that the plan is using. It's just something that's pretty unique, and I think it's something I'm not saying it's been good or bad, but it does seem to be a factor from the data that we've seen, and so it should be evaluated. Is this working? And then also looking at that negative amortization issue and how to tighten up your amortization periods to pay off your debt in a more prudent fashion. And then finally looking at the benefit design and kind of going back to that chart I was showing you about when people leave the system, and considering whether if this benefit is matching the retention trends that you want to see, and while still providing retirement security benefit, and would another alternative or offering choices or that sort of thing be a good thing? And there's lots of different ways to do that. People tend to focus on defined contribution plans as being sort of here's a less risky way of doing it, and that's certainly true, but there are many others. There's hybrids that have defined benefit pension and a defined contribution plan kind of together, which you have here in not your teacher plan, but your main state plan. You have others that are sort of stacked on top of each other. You have cash balance plans. There's just lots of ways to go about this. And even on the defined benefit side, one of the things that we've now seen, and we've helped build new defined benefit plans for new hires. I'm not taking anything away from anyone that's already there, but for new hires, new defined benefit plans that have different cost and risk sharing underneath it to basically minimize the probability that you have unfunded liabilities, and also put some other guardrails and controls in to basically offer a pension, but offer one that's going to be more sustainable in the long run, and then basically use attrition and time to let the problem sort of filter out. So with that, Mr. Chairman, I will wrap up, and I'm happy to take any questions and even stay after if it would be helpful.
Thank you, Lynn. Questions from the committee? Number 26. Yes, sir.
Yes, thank you very much. This is fascinating. And one of the things that came to mind, and you may have covered this in, I guess, slide number 8, which was the causes of the pension debt. But I was curious if where would the slow growth of the headcount fall into the buckets of the causes of the pension debt. So I know that we saw underperforming investments and interest rate smoothing. That's the big chunk. But I was curious which other bucket that would fall in. Is that something that's of any significance at all?
Oh, absolutely. And I'm to pull it up, I might crash the computer. But I think it's called demographic assumptions on that sheet. It might have a different name, but that's where that would fall. An interesting thing, Representative, you're pointing out an interesting angle, so just to dive into that for a second. I'm going to use payroll growth, for instance, as an example of how, I don't want to say sneaky, it's kind of a cheeky word, but how assumptions that nobody really thinks too much about can actually have a profound effect. The way that pensions are typically funded, oftentimes are using a method, again, I'm getting a little technical, but I'll explain it. They call it a level percent of payroll method. What that basically just means is that, rather than call this a fixed dollar figure like a fixed rate mortgage where it's just the same dollar every year, something like that, they would say, we're going to just basically fund this plan as not with a dollar figure, but with a percentage of the total payroll. And they will then look at, okay, over time, we assume that payroll is going to grow, right? And so we're going to basically tie our contribution rates to a set, percent of payroll. And what we've seen this plan is we've seen some variation here on that, much more in other states on this particular metric. But if you're basically saying we're going to contribute based on an assumption of a growing payroll, and then that doesn't happen, this is what happened in Michigan. They were assuming a 4% payroll growth and we're having 0 in real life. And so that just compounded the accrual of debt. because they weren't putting in enough money. They were assuming that just payroll growth was going to take care of it. And if you attach a fixed percentage to that and it grows, well, the whole thing's going to grow, right? It didn't work that way. And so I know that wasn't the particular assumption you were sort of pointing at, but there are many of those that have that kind of effect where we fixate on the assumed return and that because that's the one that everybody kind of intuitively understands. But there are these others that are really profound, operating under the hood and kind of behind the scenes that can be major levers. So it's not just one thing. Thank you.
Additional questions? Mr. Jones.
Sir, thank you so much. I just have a small request. I don't want to take too much of the committee's time, but I'd be really interested in benchmarking. Where do we sit as opposed to the other 49 states? Where do we sit in terms of some of the key metrics that you were providing to us today in terms of employee growth, wage growth, assumed return, discount rate, you name it, and anything like that? If you'd be able to provide that to the chairman, I know the chairman and his assistant would be able to get that out to us so that at least we could get a better understanding in terms of as a state or as an entity, exactly where do we fit? And I sure would appreciate that, okay?
Thank you, Representative. I will do that.
Thank you.
Thank you. Further questions? I want to, ask one if I can, and then if the committee has questions, if there are no further ones, I'll ask if you don't mind entertaining from the audience. So I was doing some quick math here, and even though you and I did this a few weeks ago, and I've looked at the slide, know a little bit about what you used on one of the slides as a normal cost and then total cost. And our normal cost was like trying to find the slide. Oh, there you go. All right, so our normal, like this year, the 17-18 gross normal cost was 13.77. Unfunded liability cost is 13. That's what we're putting in to try to catch up with our debt. Basically, the way you're looking at it is that true? That's on your slide, small number 7. So looking at that, our payroll, the way the percentages go, it looks like a percentage of our payroll is about 900. I have to slow down when I say this. 1% of our payroll is about $950 million. So this year, give or take, maybe it's 925. So the 20.9% that Georgia is putting into this plan this year is almost or a little over $1.9 billion. So it's about $920 million a percentage point. So what I'm looking at here is our unfunded liability, 13.13%. Give or take times $900 million is $1.23 billion that we're putting in toward our debt. Again, those are round numbers. Mm-hmm. But then I looked at, we consider in our earnings going forward, we consider that debt to be, that would accrue at 7.5% because that's the numbers we're using, right? I mean, so next year, if we owe $18 billion, we're going to pay down $1.23 billion. Again, give or take numbers. But 7.5% of the $18 billion is 1.3. So we're barely paying. We're paying off our debt. Even though it's a large sum of money and it's $1.9 billion, including the normal cost, we're paying that off. And you, I think, told me what I thought it was on a 27-year or something. We're paying it off almost like a 30-year mortgage, a closed-end mortgage. So I mean, something for us to understand is that even though this is a big number that we increased this year and last year $250 million and $360 million this is a debt out there that we're paying off a little at the time, and most of that is going to interest, if you will. Now the interest is what we owe ourselves. It's like in my mind, the best analogy I can get is it's like in the old days, and maybe people still do it, but in the old days, borrowing against your old whole life insurance policy. Because if you borrowed against that, then it was counting on getting whatever return it was in order to pay you so much at either death or a certain point, whole life at 60 or whatnot. Am I sort of right when I capture that the way we're amortizing this and paying it off 27 years, we're just paying a little bit of the debt down, and we're really just putting the 7.5% return. Is that sort of?
Mr. Chairman, it sort of. One way to think about this, right now you've got an issue that we didn't really talk about, but you are basically using that kind of method that I mentioned where you're tying, it's a percent of payroll, and you're basically assuming some growth in payroll over the long run. And you amortize your debts in a similar fashion. And we think that effectively you're backloading the contributions to this plan. So not only are you not putting in enough to like keep up with even the interest on the debt, much less pay down the debt today, but you're also kind of punting into the future. You're punting continuing problems down the road. And so by this backloading, and I say backloading because you're assuming a growing payroll, and so basically the big dollars in that amortization are not today, they're tomorrow. They're at the end of that term. It's not just a level dollar kind of payment over 30 years, which would be a lot more manageable and predictable. From a fiscal standpoint, you're basically saying, we're going to roll the dice that for 27 years, we're going to hit this assumption and these numbers are going to add up. And if they don't, it ends up adding more to the back end. I've got a chart here that sort of shows something like that. This is sort of a very simplified way of illustrating it, but, whoops, sorry, I'd go the wrong way. We have an illustration of what that backloading kind of might look like. Sorry, we're stuck here, so I'll point you to it just as a slide reference. This would be slide 22. When you're wrong, you can have some major effects. And I'm not saying you're going to be wrong, but there's a risk, and that's why we're here. I mean, that's what we're talking about, is risk. And so the backloading, I think, is the bigger issue. Yes. So let me just explain this. This is a tricky slide, but I can explain it very briefly and I think very simply. We talked about the difference between a normal cost and the unfunded liability, the debt payment. That's shown just the dark bars. At the bottom is the normal cost. Light blue on top is the amortization. Now let me show you the slide before this. Oops. We took sort of the numbers from TRS and just did a very simple kind of looking forward, over the next 20 years or so. There's not going to be a lot of movement, we think, on the amortization payments as a percentage. If you actually turn that left axis into dollar figures, this thing would be spiking up. But because it's a percent, it's going to be fixed, basically relatively steady. But if you're wrong, and if you come in and not at 7.5%, but you come in at 6%, that's what this is showing. The yellow bit at the top, that's the previous, the baseline. That's what previous slide topped out at, if you hit your return. So everything above that yellow line is sort of what happens. It's the price of being wrong, if you will. And if you hit, say, a 6% return, this is just one number, one assumption, you'll see what happens, and you'll see the effect gets backloaded over time. And what that would do, just being off 150 basis points, would be about $12 billion, and according to our calculations, in additional contributions that would be required to pay this off. Yeah, $12 billion. So this is, maybe one simplified way of visualizing that dynamic we were just talking about, Mr. Chairman.
Thank you. I think the $12 billion got Representative Fraser's attention.
I just have one last question, Mr. Chairman. You talked about the percentage set at 7.5%. That's sort of like a fixed rate, and other states are probably using this too. So my question is, you also talked about a risk-free rate of return.
Mm-hmm.
What's a risk-free rate of return in today's economy?
Mm-hmm. Great question, Representative. So that's sort of a jargony term, which basically means let's look at the U.S. Treasury yield. 30-year U.S. Treasury yield. Because basically it's viewed as one of the safest assets on the planet. And so when we talk about risk-free, you're absolutely right. There is nothing that is risk-free in real life. But as a technical or professional, I guess, jargony term, risk-free rate of return is basically like, what's the safest investment out there that we can conceive of? And it's basically, treasuries would be the first thing that most people would come up with. So, right now they're at about 3%. Is about where they are, and I think even today there was a slight nudge up in that. But what we're not seeing is a return to the sky high days of like 10%, that sort of thing as a risk-free rate. I hope that answered your question.
I don't think we have any more questions. I want to ask this one. In our actuarial data, What do we assume, because I know your plan showed that, I think 73% of the folks that start in the profession will leave before they get vested. Are we taking that, what do we assume? When 100 people come to work here, do we assume that only 15% will make it to 30 years?
Those are your numbers. Those are the numbers for that system, yes.
But I knew those were what they were, and our plan is based around that as well.
Mm-hmm.
Okay.
I mean, this is what basically the actuaries, this is how what they think the trajectory looks like right now.
Absolutely.
5 years from now, it'll probably look a little different.
Sure.
They move a little bit, but this is consistent with, most teacher plans sort of look like this.
Okay.
And some of it is you have people that move, people, it's not an easy
Do
job.
different things.
It's a difficult job, and some people don't stay, and there's a lot of different reasons, but this is a similar trajectory to other plans.
Representative McGowan.
Yes, sir.
Sure.
I've heard you mention defined contribution, hybrids. What's the trend in this direction on the national stage?
Great question, Representative. Depends on what time frame you look at. So generally speaking, if you look at the last 20 years or so, the number of states have gone to and actually later in the printout I do have an appendix that's got some of this stuff sort of laid out, and what states have done what. Hybrids, I would say, over the last 20 years have probably been the most embraced out there among the states, up until about 5 years ago. And Georgia did this, and the other your state employee plan. Virginia's done this, Tennessee, a number of states. The federal government, what they call the thrift savings plan, is basically a hybrid. It's a defined benefit with a defined contribution on top. The federal government even does that. So I think the military is looking at moving into something like that, or they may have just done it. I forget where we are in that process. But anyway, hybrids have been, I would say, popular. But over the last couple of years, I would say, if you look at the last 5 years, some of the ones that we've worked on and others out there, you look at states like Arizona with public safety, Michigan teachers, Pennsylvania. There are bills in different states right now, similar bills that would look at not going from one-size-fits-all system to another one-size-fits-all system, but rather saying, look, some people want a pension, so let's offer one. Let's just pull the dials a little bit so it's going to be sustainable. And then we can offer something else. You could offer a hybrid or a cash balance plan or defined contribution plan, it could be lots of different alternatives, but you could provide both so long as both are risk managed. A defined contribution plan is basically already risk managed by definition, but if you had a risk managed defined benefit next to it, offer those choices and let people let people self-select. And that has been a theme. We worked on that now twice in Arizona, first with police and fire, with the union support, and then the correctional officers last year and probation officers, similar kind of choice-based construct. Michigan did this with teachers. I think I mentioned Pennsylvania has been another state that's embraced this. So we're now lately, in the last 5 years, we're starting to see more going, maybe it's not just one system, it's options. And I think there's a lot of reasons for that, but I think just people tend to like choices, I think is why that might have more appeal than one-size-fits-all systems. Oh, and I guess I should say just the last point. That's what I just described as for the systems that are transitioning to some other benefit design. If you look at just the current traditional defined benefit plans, 49 states or something have done some adjustment on those, just the current systems, meaning changed COLAs, changed retirement ages, made adjustments to contribution, lots of different things. So that's kind of a quick snapshot of the universe of reform.
Thank you.
You're welcome. Thank you for the question.
Anyone in the committee have any further questions? Does anyone in the audience wish to have a question? I'm sure Lynn will hang around and answer some face-to-face questions if you wish to ask them that way. See no questions. We went a bit over time, but I think it was well worth it. I appreciate the gentleman's information. I appreciate
Thank you, Mr.
you
Chairman.
and your organization, the Reason Foundation, allowing you to come down here on their nickel and not the Georgia taxpayers. We appreciate the information you've provided. I just want to close as we did when we presented up in Cobb County, again, by saying that anybody that's looking at this, you know, the chair's intent, and I would venture to say no one's intent is to take anything away from a teacher or a retired teacher, but instead to honor the promises and commitments that have been made to them, and for us to all realize that we have that hole that we need to fill in, and the faster that hole fills in, the faster it frees up that 13% times $920 million. I mean, that in and of itself is over $1 billion a year that it frees up in the budget when that gets paid off to do other things with. They could be in education, they can be in other needs and transportation and great needs around the system. But we have to realize that, you know, this year that $1.9 billion of which, you know, 1.2 of it is filling in a hole is a large percent of the state budget. So that's what we're, you know, here to try to look at. We the other thing I would say is this committee's looking at you know, future funding, you know, statewide. You know, anything that is done with the reform of the pension system will go through the House and Senate retirement committees, I'm sure. I mean, I'll leave that to the Speaker and the next Lieutenant Governor, but that's where those things go. They have a process. We're not trying to insert ourselves in that process other than the cash flow and the financial management to work with our appropriations chair, our Ways and Means chair, and all 180 members of the House and 56 in the Senate to honor our commitment and promises to our educators. And quite frankly, I think we can look at this on all of our retirement systems. It's just TRS happens to be the biggest one in terms of capital assets. No further questions, no further thoughts before the body this afternoon. I see no lights. It's a late hour. I thank everybody again for their time. If there's nothing further, we'll stand adjourned without objection. See no objection, we are adjourned.